Good afternoon and welcome to Ugly Duck 2024. When I was preparing for this presentation today, I was trying to come up with an angle on venture capital in Europe that could entertain you. And I found out that this is increasingly difficult because the industry of venture capital has come of age. We have been through pretty much all the cycles that you can imagine. We were coming from nowhere when we restarted venture capital in Europe after the technology crash in 2000. We have made it to the spotlights in 2019, 2021. And today, we are struggling again for attention, for funding, for scale. And still, we thought we had made it, that we would have earned our seat on the table with the big boys. But then, before the summer, there were some disturbing news coming out and publications mentioning that venture capital in Europe delivered returns that are 5% lower than in the US. So are the US beating us again? I spent sleepless nights, like many of you, I guess, on those figures because we were preaching that we had closed the gap, that we leveled the US in returns. And yet, those publications hit us again. So I decided to go to the roots of those publications and see where we got it wrong, because 5 percentage points, this is a universe. And the first thing I did, I dug out the publications that have been brought out before the summer. And indeed, if you look at the median returns of the venture capital industry in Europe and in the US, there is this 5% gap. Since we have been preaching for so long that we had closed the gap, I could not be satisfied with that, and I wanted to go to the roots of what is behind this. And it was not possible otherwise than to go to the basis of the statistical data. So I called our friends at Inside Bavara and asked them to provide me with the data points that are behind those curves. And I was looking at it from two perspectives. First of all, I took a look at all the funds in the data samples in the US and in Europe in this publication that had a DVPI higher than 1, meaning funds that were in the money. And I looked at it. And I came to the conclusion that, well, there is this tiny little rounding difference that there always is in favor of the US, but this is not something that can explain a 5% difference in IRRs in the median value. So I looked at the other side of the spectrum, which are the returns of funds that did not report a DVPI of 1, but that actually reported one of 1 or less. And whilst in the US sample, there are 27% of funds that are with a DVPI of less than 1, Europe reports a share of 42.8%. How is this possible? Well, the reason for this difference between the US and Europe is because the US do not have an EIF. The reason why this exists is because EIF indeed is a very peculiar investor. We are an investor who takes risks that others don't take. We invest in new fund managers, first-time teams. We invest in new sectors, new geographies. And we do have investment mandates that allow us to carry exactly that risk. But whilst the mandates that we are investing from take this risk very consciously because we want to create a rejuvenated GP community in Europe, we want to bring new sectors to the market, we want to explore new geographies, we want to bring emerging managers to institutional investment grade. While we do this in a very deliberate way, the investment base that is reflected in the Insights Bevara figures does not adjust for the same data bias. And I tell you why. At EIF, we run an investment administration system called eFront, which feeds, like every eFront user, into the databases of Bevara Insight. Hence, all our sample goes into that. The US sample of Bevara Insight also comes from eFront users in the US that also feed all their data into this database. But the US does not have an investor that covers the same investment spectrum that EIF is covering. And we are the biggest data contributor to Bevara Insight in Europe. So I was going by the assumption that this would have an impact on the data distribution, because in the US, people that can afford running a system like eFront are typically institutional investors, and hence are of a different degree of selectivity across the investment spectrum than EIF would be. So I tried to go down the routes and try to assess what the impact on those statistics would be, and this is the result. First of all, I was looking at the DVPI distribution of the entire venture capital portfolio of EIF. And that's the outcome. And then I was comparing it, what happens with this distribution if we focused the analysis only on the funds that are of institutional investment grade quality at the time of investment. And that's the change that we see happening. Now, if I did the same analysis as the publication that I was referring to just before, in order to derive the median IRR of our venture capital portfolio, this would be the outcome. You will see the line is pretty much along the values that are displayed by the Bevara Insight database. We could say it's a good proxy to say that we are the majority of the data points that they have got in the system. But now, let us look what happens if I remove from that sample that is on the basis of that chart those funds that are not institutional investment grade at the time of investment. And this is what happens. Well, you will say, this is still not matching exactly the curve that we have for the US market, and that is due to the fact that a few of you became so successful that they don't need EIF anymore in that capital base, and hence are not part of our sample anymore. But if you look at the charts that are on display here, it is not a massively statistically relevant difference anymore, and it is not monodirectional either. So, is the conclusion from that that it's a very bad idea to invest in emerging managers? No, it is not. And actually, quite to the contrary. Because if we look at EIF's investment performance in our portfolio, our track record would not be the same if we had not the community of emerging managers in our data sample. Let us look at how this pans out in the performance statistics. From our top quartile portfolio, 26% are of non-institutional investment quality at the point in time where we make the investment. And even more impressively, 2/3 of our top quartile performance funds are fund managers that are qualifying as emerging managers, which means that the funds that are in the data sample that is relevant for this analysis are either the first, second, or third generation of funds. And if we look at how this pans out in terms of investment performance, well, if we take as a first shot the comparison of the cutoff performance for the first quartile, taking into consideration our entire venture capital portfolio and compare it to the portfolio of institutional investors only, the values are virtually the same. If we look at the cutoff performance between the first and the second quartile for institutional investors and all VC, the cutoff actually is slightly lower for the sample that includes emerging managers, which is what you would expect because of the greater volatility of returns. However, if we have a look at the cutoff performance for the top 20 best performing funds in our portfolio, the outcome may be surprising. If we take the entire VC portfolio, including emerging managers, the cutoff performance for the top 20 best performing funds in our portfolio is 28% compared to 19% if we excluded this sample. That is something which gives us an indication that despite the fact that having emerging managers in the portfolio undoubtedly increases the volatility of expected returns, if you can overcome the spread of distribution of expected performance by superior selection skills, the return potential from emerging managers is pretty high. And since EIF, since more than 20 years, is backing first-time teams, emerging managers in emerging geographies, this is one of the major value contributions that EIF can make to the construction of the venture capital ecosystem in Europe. Now, how has the venture capital industry been faring in the complicated market environment over the last couple of years in this context? Here are the performance figures from our portfolio, all venture capital funds taken together, all funds that have at least 40% of their capital drawn at the date of 30th of June, 2024. And we have the evolution on screen for the last 6 vintage years, starting before the kind of hike in the performance of venture capital in Europe in 21. And we have seen the evolution since. We've seen it all. We've seen the peak in 21. We've seen the correction in the market. We have known the valuation corrections in the portfolio. But where do we stand today? Has the market found ground? Have the valuations started to bottom out? If we look at the performance figures from June 2024, we could say, yes, it is. Valuations seem to have stabilized. The trend that we have seen over the last 3 years has come to a halt, and we have found back the valuation levels of 2018 roughly, which, if we look at it from the bright side of things, has been the base camp of the biggest ascent that venture capital ever took in history, soaring to unprecedented peaks in valuations and investment returns. But mind you, if we compare the peak times of 2021 to the performance levels in 2024, the correction that we have been going through has translated into a decrease of our cutoff returns for the first quartile from roughly 33% in Q2 2021 to a valuation level or a performance level of 15.5% in June 2024. So basically, over a period of 3 years, the cutoff return between the first and the second quartile in our portfolio has halved. Nevertheless, the impact of the correction on the distribution of capital to investors in our portfolio has not been massively affected. We observe roughly the same levels as we have been over the last 3-4 years. If there has been a dilution in the TPI ratio of our portfolio, it was more because of the increase of our portfolio that we have heavily invested in over the last 3-4 years, rather than the expression of a massive slowdown in the distribution from our fund portfolio. So if we look at all this, can we say European venture capital is indeed ready to be a real asset class? Well, I was asking myself, what would you do if you sought exposure to a technology company or technology companies in your portfolio as an investor? What would you do? You either have the choice of investing in the irresistible value proposition of European venture capital, or you could buy the Nasdaq index. In between those two choices, that's what happens if we plot this against the timeline of the last 26 years. The gap of time-weighted return between the two is, as you can undoubtedly see, absolutely massive. Now, I know that this chart is not totally fair because it takes into consideration the vintage years in the early years of this century, where venture capital in Europe was considered being more of a charity. And it is an industry period where we have actually made our mea culpa already, and we have apologized many times for those vintage years. But even if we take those years out from the analysis, and if we look at the last 10 years only, yes, the difference in performance between Nasdaq and the time-weighted return of the venture portfolio decreases from 5% to 2%, but still we don't match the performance of the Nasdaq. So VC is irrelevant. Well, in the light of the fact that we have still difficulties in fundraising, that nobody is queuing to get into the fund in venture capital in Europe, we need to ask ourselves that question indeed. Why would you invest in an asset class that delivers inferior returns, has less liquidity, and takes more time to deliver returns? The answer to that is because you cannot have one without the other. Of course, it is impressive to see the evolution of the Nasdaq over the last 20 years. Of course, we know that we are at a new peak in the historic stock exchange levels, including Nasdaq. But what you see in the yellow surface on this chart is the venture capital-backed share of companies quoted on Nasdaq. This is the amount of companies. This is the level of the index that is represented by companies that prior to being quoted on the Nasdaq have been backed by venture capital before they got floated. And if you take that out from the equation, this is what is left of the stock market return that you could capture if you went to the market to get your technology exposure. So somebody is taking a free ride. Who is it? Institutional capital is. Because if we look at the share of fundraising that venture capital in Europe materializes from institutional investors and notably from pension funds and insurance companies, it amounts to 13% of total fundraising. Pension funds alone account for 6% of the total fundraising volume of venture capital in Europe. And yet, they should be the institutional investors that have the biggest affinity with long-term investment horizons and could actually carry all the reported downside of having illiquid alternative assets in your portfolio. Pension funds manage 3.5 trillion euros of assets in Europe. And their exposure to venture capital in Europe is 0.01%. But the free ride that they are taking on the financial returns is not the only free ride that is taken here. Less than 2 months ago, there was a report published by Draghi's team advocating for the need of 800 billion euros of annual investment in growth and innovation and in the transition to a sustainable economy that is necessary for Europe to maintain or regain its competitiveness on a global scale. The venture capital industry in 2023 managed to raise 14 billion of capital, equivalent to 1.7% of this amount, and being spent over the investment period of the underlying funds of a period of, say, 3 years. How is this going to work? How can we claim that we want to stay at the forefront of technological innovation and competitiveness if this is all that we are ready to invest in innovation? If we are looking at the innovation environment and the role that venture capital has to play in this context, what will not happen without VC? There will be no energy transition through nuclear fusion without venture capital. There will be no protein engineering to fight major diseases. There will be no space tech supported agri-tech. There will be no cybersecurity. There will be no quantum computing. Innovation without venture capital will not happen. At least it will not happen in Europe. Because if venture capital can't find the scale in Europe to support innovation, if innovation cannot find its spaces in Europe, it will find other spaces where it can find the scale, the talent, the ecosystems to grow. And I'm wondering, on the outlook of the institutional investment community in Europe, where are they going to find the contributions to the pension plans and to the insurance premia that they are collecting in order to feed their asset under management base in the future. If innovation on this chart takes the turn to the left. Are we all in denial? Or do we have to change our own narrative and our own ambition? How can we convey the urgency of having to take care of an investment environment that fuels innovation if the only ambition that we convey is the ambition to overcome the difficulties in raising our next fund, to increase our own assets under management, to make simulations on management fee income on our management companies? Isn't it up to us to change the narrative to what we could do in the context of the innovation that is called upon in the Draghi report, and to create this innovative, competitive Europe that we are collectively dreaming of? I want to leave you with one big appeal. When you leave Ugly Duck today or tomorrow, and you return to your home base, start a new narrative of venture capital in Europe. Start a new narrative of what could happen if venture capital was given the opportunity to make innovation flourish. And when you are standing in front of a crowd of institutional investors for the next time, don't talk about your business model. Talk about the finity of the business model of institutional investors in the context of a European economy that is no longer competitive. And if you're standing in front of institutional investors that tell you that they are not investing in venture capital because it's too risky, or because it's not part of their asset allocation and risk appetite, we stand here and have the collective duty to convey the message that this is not an option. Because the biggest risk that Europe is facing right here, right now, from an economic perspective, is to have no venture capital at all. And when you then get to talk about your next fund, don't tell us what you have done, what you have achieved in the past against all odds, but reflect on what you could do to make the ecosystem for innovation finance in Europe a thriving space. Tell us what you could do if only we let you. Thank you very much.